Good morning, I am Jenna. I have Nick Ung, CFA charter holder with me. Nick is our portfolio manager for the Tranel Financial Group and lead portfolio manager for Liberty One Investment Management. So welcome.
Yeah, thank you. Thanks for having me today.
So I want to talk about what's hitting the news right now, right? The coronavirus. It's every headline. I mean, you have an Apple Watch, it's popping up consistently. It's there. Can you talk to that, right? It obviously has an impact on, the human race, but can you talk to the impact of the economy and the stock market and the coronavirus?
Yeah.
Or is there an impact?
Yeah, so that's a great question. And as you mentioned, it is in the headlines. And from a health standpoint, from a scientific standpoint, I cannot really comment too much about it. I know a little bit about what it is and the effects it has on people's lungs capacity and fibrosis of the lungs. But outside of that, it's a really new virus and relatively uncertain virus, and it certainly has consequences on the human race. But from an impact on the economy and the stock market, there's a couple things that I think would be worthwhile talking about. First and foremost, of the economy, I think from a global economy standpoint, it has a lot of disruptions with economic activity, with trade flows, especially as towns and cities and municipalities really goes on lockdown and really no economic activity is really generated. So from an IMF standpoint, they did lower its economic growth outlook this year. But really when we look at the US economy, so far right now, I think the US economy naturally is a closed economy relative to the relative to the global standard. And what I mean by that is, if you look at imports and exports and flows in and out the U.S. economy, a very small percentage of that is really small percentage of that is a component of our GDP growth.
Okay.
So from the resilience of the U.S. economy, I think the coronavirus has minimal impact right now.
Okay.
Obviously, the virus is a pandemic like this is a black swan event. No one really knows what's going to happen.
Right, uncertainty.
And I think that's part of the reason why the stock market sold off as well. Is if there's one thing with the stock market is that it does not like uncertainty.
Right.
And usually when there's uncertainty, people require higher premiums, and hence it brings down valuations as such. Because if you think about the components of the stock market's total return is really made up of three components. It is the dividend yield, earnings growth, and change in valuations.
Okay.
Really, if you look since the start of this year, we obviously just are in the latest stages now of the earnings season. Companies' earnings for the fourth quarter, for the most part, is pretty strong. I mean, 75% of companies beating earnings, and then about 63% of companies beating revenue estimates. So from a earnings growth standpoint, companies are doing relatively well. From a dividend standpoint, companies are still continuously, paying out dividends, and the share buyback yields are there. And really, the only change in there is really change in valuations, which is really of two components. Interest rates and sentiment.
Okay.
From an interest rate standpoint, the Fed has continued to maintain pretty accommodative. And so
Right,
when we look
yeah.
at the last two trading sessions, if you take out all those, if you really look at it objectively and take out the components, the one driving factor that we see is really driven by sentiment. And when we look at sentiment, one of,
When you say sentiments, do you mean emotions?
Yeah.
Like buying
absolutely.
per emotion, okay.
Absolutely,
So
yeah.
buying on those emotions, and okay.
Yeah, and what we're seeing now is, investors act now, think later.
Right,
And
we've all seen that.
And you see that, one of the questions too is the coronavirus has been in the news since January. Why wait till the last two trading sessions
to have an impact.
to have this type of reaction? And
That's a good
it
point.
goes,
That's a really good point.
yeah, it goes back to the uncertainty, right? For the most part, coronavirus has always been a China issue. It wasn't until this past weekend where we see a huge spike in cases in South Korea and Italy and Iran.
Yeah.
And so now the whole thought process is, this is no longer a China issue, it's a global issue, and what does that really mean? And
that's
there's
when
a lot.
the headlines are coming in.
Absolutely.
Scaring or amplifying the true effect of it.
Absolutely, yeah.
Okay.
And that uncertainty is what causes a lot of that trigger that emotional reaction.
Okay.
But the second thing I do want to point out too is that the magnitude of this sell-off that we're seeing in the last two trading sessions, we've been in a tailwind of flow into more passive index funds.
Okay.
And this has been kind of a industry development. So if you think about it, back in the 1980s or the 90s, a lot of flow, a lot of the assets, liquidity in the market were driven by institutional assets. And they were driven by institutional assets because a lot of companies used to have pension plans, and the companies were liable for the obligations of the employees or their retired employees. And part of doing so, they're hiring institutional managers to manage their pension plans, and naturally those assets flow into the stock market. And so back in the 80s and 90s, we're seeing more thought diversity managed by different institutional fund managers with different philosophies. But what we're seeing now is that pension benefit plans are kind of going away, and 401ks, employee-directed plans, are really flourishing.
Right.
And as part of employee-directed plans, they aren't being moved to institutional managers. And so, in terms of trigger points, like when to buy and when to sell, the trigger points, they're being triggered by employees and no longer by institutional managers managing different
I never
fund
thought
managers.
of it that way.
Yeah, and so
That's very eye-opening.
Yeah, and so what you're seeing now is that as more and more 401k plans or 403b plans offer ETFs or mutual funds,
Yes.
a lot of the retail flow is what we're calling that, is really driving the movements in the stock market.
That's super interesting.
If there was a sell-off, the magnitude is amplified from the additional herd flow of retail, and from the downside and also the upside. And so, that is something to be mindful of. It might be the new normal. And I think in terms of investors and what we do about it, I think the biggest thing one can do is really to think objectively instead of act first, think later. To really think first before you act.
And that's why you work with a financial advisor, right? You consult with that advisor first to make sure that you are acting in the best interest of your future.
Absolutely. And even if not for that purpose, talking to someone like an advisor or a third party, provides a great sounding board for you to at least think about your thought process and what really matters.
What is objective? That
Absolutely,
type of thing.
yeah.
Okay.
Because you don't want to make an emotional impulse decision. And have it be a huge financial mistake.
Correct.
In the long term. And so, that's one thing. If I can encourage, at times like these, is to really think objectively, right? If you are a younger individual, you're purchasing businesses and, thinking about if I'm willing to buy Apple, who's generating about $50 billion in net income, every year, or its most recent fiscal year, what price am I willing to pay for Apple?
Right. What's responsible for you?
Yeah.
That's okay, Nick.
Yeah.
That is.
So,
I'm excited.
Yeah.
Because
Absolutely.
you have actually helped calm these headlines that are creating such an emotional scare to people by put it in a very simplistic format to show the impact. I'm excited right now. I'm super excited right now because that's such a great way to look at it.
Absolutely, yeah. And so, it's at the end of the day, it's a great reality check for a lot of people.
Yes.
If you're in retirement, it's a great reality check in terms of how much of your retirement assets is really driven by the ups and downs of the market. Because as you and I know, we were in the industry and we're part of a financial firm, is that there are a lot of different strategies for income generation, right? You don't have to rely solely. You don't have to rely solely on the stock market for your income in retirement. There's a plethora of options and strategies out there that I think that as retirees, it's great to at least be aware and know about that, whether it's talking to an advisor or doing some research. So it's a great gut check for clients who are maybe 10 years, 5 years away from retirement, where they still have a big portion of their assets in the market. It's a great gut check to evaluate your risk exposure and your risk tolerance to how much risk you're willing to tolerate and be exposed to. and how much fluctuations your portfolio is exposed to the market.
Okay.
And so it's a great the time to rebalance your portfolio if you feel like you've been too risky on equities. And then the last thing I would say is that not all equities are created equal. I mean, the media has a tendency to lump and say, hey, equities, they use the S&P and the Dow to say, hey, in general, equities are up or down. But you can also still be in equities, but be in a more defensive position, right? Utilities and consumer staples, those segments of the stock market did not sell off quite as much,
right?
As the S&P 500 or the Dow, the major indexes. So there is still opportunities to be in equities without having to take 400% of the downside. And so, if you peel back the layers of the onion per se, you're seeing a little nuggets of value that you could provide, whether to your overall portfolio, the way you strategize and evaluate how your risk or your income generation or your financial objective.
Definitely. Well, thank you, Nick.
Yeah,
thank you. That was very. It's exciting to know that we're probably not as, it's not impacting us as much as what we would think it would be, right? And it's really just a tactic of the local media, which we all know, deep down, we all know that the media is doing that to our head at times as well. Yeah. So thank you so much for giving us your insight. I sincerely appreciate that. And I hope that we were all able to take something away. If you have any questions, reach out to us, 847-680-9050. Any of our advisors would be happy to answer any of these questions for you. And I think that it's good. It is, what you said it best, it is a good way to objectively check if you're in line for your future goals.
Yeah, absolutely.
Okay, thanks, Nick.
Thanks for having me today, Jenna.